So we're absolutely delighted to have David Barr here with us today. Mr. Barr is the CEO of Pender Fund. Pender, he is also the portfolio manager of several of Pender's funds. In 2021, he was honored to be recognized as Investment Executive's Mutual Fund Manager of the Year, and the Pender Small Cap Opportunities Fund, managed by David, was recognized for the fourth time as a Refinitiv Liberal Funds Awards Canada winner. He began his investing career in 2000. He initially worked in private equity, which gives him a unique background to investing capital. At the end of 2007, he became a partner at Pender Fund Capital Management and was appointed to Chief Investment Officer with the objective of launching Pender's mutual fund business. In April 2016, he was appointed president and CEO of Pender, and in July 2021, the role was split with David remaining CEO. He holds a Bachelor of Science from a degree from the University of British Columbia and an MBA from the Sulich School of Business. He's also a past president of CFA Vancouver, having also served on its board of director for 4 years. In December 2012, he was recognized as one of British Columbia's top 40 under 40 business leaders by Business in Vancouver. Thank you for joining us today, David.
Thank you, and sorry for giving you the long bio.
No worries at all. That's fine. That's completely all right. Excellent. So why don't we just begin by you sort of walking us through your investment philosophy, and we'll go from there.
Yeah. So my investment philosophy, I mean, I'm really a bottom up stock picker. So I jump out of bed every morning trying to figure out how businesses work, and in the process of figuring out how businesses work, really try to understand the quality of the business and what that business may be worth to a third party or even the market at some point, either today or in the future. So really, it's diving deep on a company and the securities they issue, and I think that comes from my background. I started in venture capital, the private equity space, where it's a really deep, lengthy due diligence process, getting to know the company and the industry, because when you're buying something that's private, if you want to get out, you can't. So you have to do your work and get to a high level of conviction that you want to be invested there.
Yeah, absolutely. I think that makes a lot of sense. And so what sort of area of value investing do you associate yourself more with? Is it more the modern Buffett moat type of approach, or is it more, let's say, a deep value approach, a more cigar butt approach? Where along sort of the value spectrum do you find yourself?
Well, I ideally in the more Buffett approach. I think when you look at generating returns in the market, the majority of the returns, I mean, you can generate some returns trading, like buying things at a discount, and when the gap closes, make your profit. But the real, like the Lollapalooza is really when you get the economics of the business driving your returns. So for me, it's really trying to identify businesses where the internal economics are going to generate really strong long-term double-digit rates of return. And what's great is there's a lot of businesses out there that can do that. And today some are cheap. Actually, today a lot are cheap, but other points in time, a lot of them are expensive. But there's always something to do. But understanding, where those businesses are, and then, but I mean, when you kind of look into the spectrum, when I'm walking by a cigar butt, I'm not going to pass it up if there's a lot left to smoke. So if you can buy cigar butts at a really substantial discount to what you believe the intrinsic value is, that can be very rewarding as well. But it's you have to know how you're wired as you employ these different techniques. I mean, if you're investing in cigar butts, running a 10% concentrated position and like 10% positions in cigar butts, that's probably a little bit more dangerous. If you want to be more concentrated, you really have to be more on the quality spectrum of things. And then if you're more in, and we call cigar butts and deep value more a close the discount, where you're trying to generate the economic returns from basically just mean reversion, and you have to be a much more nimble trader in those areas. So if you buy something cheap and it gets close to fair value, it's probably time to move on. Otherwise, you're probably, there's a high probability of a round trip, because just because someone thinks it's worth what you do today doesn't mean they're going to necessarily agree with you tomorrow in the market.
Yeah, absolutely. And let's also talk about your process for idea generation. So how do you sort of generate ideas to look at and to evaluate different companies? I mean, do you, for example, use screeners at all? And if so, do you use only sort of mechanical quantitative screeners, only keyword screeners, or both? And how do you use those?
Yeah, so I mean, my universe is really Canadian small cap with and in the US small cap and mostly technology. So I mean, our universe, I've been at this for over 20 years. So a lot of our kind of our idea generation is, something we've looked at 4 years ago, 10 years ago, a year ago. So it's because when you're focused on identifying these businesses, more, I guess, to your first question on using a Buffett approach, where you're looking for these compounders that can, where the economics are wonderful for a long period of time. You don't just come up with those conclusions after 20 minutes of work. It tends to be a much longer iterative process, where you get to deeply understand the business, its competitive positioning, and its advantages over a longer period of time. And then you overlay that with market events, which give you the right time to buy these types of companies. And that's usually, so you do your work when things are normal and everyone's behaving rationally, and the opportunity to buy them is when people are not. So it's idea generation it's a pretty long process, but then we also we do run screens. Like, we are always, did we miss something? Is there something we should be looking at? And really, what in the small cap space, what we're trying to identify with our screens is, companies that have, high revenue growth rates, and potential for, or indicators of a high return on invested capital. So trying to, in small cap, it's hard. It can be really challenging to actually determine what the ROIC is on a company, because a lot of times these companies aren't even profitable yet, or they're reinvesting all their free cash flow in growth. But there's some things some tricks we play on how we run for screens, where we look for those types of opportunities. And then a lot of ideas will also come out of our industry work and our competitive analysis, where we're looking at one company and we think it's pretty good, and then we look at the competitor who's grabbing market share off of them and has higher margins and a higher growth rate, and a management team that's totally aligned with a big share ownership position. So then that can be another good source of idea generation for us.
Yeah, I think that makes a lot of sense. And so you said sort of your focus is on smaller companies in both US markets and Canadian markets. How do those two markets differ for you for, let's say, micro caps or smaller cap companies?
So what's interesting is, Canada has what's called a venture exchange. And so there's a lot of support for companies going public in Canada at a really early stage. And I mean, I would say probably too early, actually. But just because something's a bad idea doesn't mean people don't do it. And so there's a lot of $50, $100, $200 million companies in Canada, and there's some that are uninvestable, but there's some that are wonderful opportunities. And with what we see with the structure of regulation in the United States, you don't have it's very cost prohibitive, and reporting. The reporting requirements are much higher, so it's really hard for a smaller company to be public in the US. And then the Canadian ecosystem has actually been built up around this. So we'll see a $200 million company with 5 sell-side analysts covering it in Canada, and a $1 billion company in the US with no coverage whatsoever. So the ecosystem in Canada it's more developed for much smaller businesses. So that's both good and bad, because there's a lot of opportunities and interesting small companies in Canada. The flip side in the US, because the ecosystem's not as robust, it makes it actually less efficient. So as an active manager, whenever we can find less efficient markets, that's usually a good place to try and go find some alpha for our investors.
Yeah, absolutely. And you spoke about just recently about how you feel like some companies are listing on the venture exchange too early. Why is that?
Um,
I'm just not now. Why are they listing too early? But what are sort of the disadvantages for these companies to list so early on a venture exchange?
so I mean, the emphasis, if you're building a company and you need capital to grow, you're gonna a lot of times you don't have a lot of options, so you choose the only option or what you perceive to be the best option. And so if you're a smaller company and you've got a $10 million or $20 million financing to go public, that can be very appealing. And I think where the challenge is, a lot of companies aren't ready to be public yet. And the advice I would give to CEOs considering taking their company public at an early stage is, make sure this is your last round of financing. Because what you don't want to become a stranded, orphaned public company that actually requires capital, because that's when things really can go poorly for you. So it's the challenge is, if you're profitable and growing and in control of your own destiny, it can be a really wonderful vehicle because you've got a public currency and you can actually utilize that in your M&A strategy. You got employee incentive plans where they actually can see the value of their stock options increasing and realize on that because it's publicly traded. So there's a lot of advantages to it, but there can be some downside if you need constant access to capital markets.
Yeah, absolutely. I think that makes sense. And touch a little bit more, please, on how you analyze management.
That's a great question. This is definitely more art than science, and it depends on different situations. So, you have to ask, first of all, we ask ourselves, how important is the management team to the business? And so if we have a business that's growing at 20% year over year and highly profitable, and they're reinvesting in the business, and we got a pretty good idea what their TAM is, and they can grow for a while, what management does is not going to move the needle that dramatically in that type of business. If we've got a business which is transitioning from a hardware business to a software business, or they're investing in a new product line and they're searching for product market fit, I mean, those are areas where management's ability can have a much bigger influence on the outcome for the business. So that's where we will, align. When we're looking at it, we try and align. Where are the CEOs and management team's strengths and where are their weaknesses? And do their strengths actually align with what this business requires to take that step function to really ramp up a new product or a new line of business or transition their business? So, and then one thing we're always looking at is incentives. We got a ton of research just demonstrating that founder-led companies outperform professionally managed companies. So we're always looking for CEOs and management teams which have a ton of skin in the game, so they have big share ownership positions, and not just your stock options, because that can create some different incentives. But people who wake up every day trying to grow the value of their largest asset, which is their share ownership position.
Yeah, absolutely. And are there any industries that you feel are outside of your circle of competence where you haven't really invested over during your career?
Yeah, I mean, this may sound strange for a lot of the people listening. I imagine it's not a Canadian audience, and I think when a lot of people look at the Canadian markets, they think of energy and resources, and I don't do a lot in either of those spaces, and not really in my circle of competence. Not really driven to understand those businesses, and I'm definitely more technology focused. So that would be areas I stay away from, but there are special situations where we can stack the odds in our favor and still do well in the space.
So can you maybe speak about one of those special situations where you did invest in the space?
Yeah, I mean, a company we own right now is a company called Spartan Delta. And it was a company started by a group about 2.5, 3 years ago now. And it was a group, Delta is for the 4th iteration. So this management team had 3 times previously built and sold very successful oil and gas companies. And they were out there as a team buying assets from the distressed debt books of banks. So when you see management teams doing really creative things like that, like getting assets at 10 cents on the dollar, they had a proven operating history. And one thing, one of the reasons we've kind of stayed away from the energy sector in Canada is the return on invested capital historically has been atrocious. There aren't too many companies with positive retained earnings as a result. So it's been challenging for investors to make money. But here's a situation where we had a very return-focused management team who, everything they were talking about was, shareholder returns and being focused on driving incremental free cash flow. So that was a situation with those factors in place, and also a really big margin of safety by being able to buy it at a very low multiple on free cash flow. The stars aligned for us, and it's been a very successful investment for us so far.
Yeah, absolutely. I think that makes a lot of sense. And maybe speak a little bit about why do you find sort of the smaller end of the spectrum for smaller caps and micro caps more attractive than maybe the more mainstream large caps?
I mean, it's an easier game to play. I know you have some really successful managers on this program, and the traditional trajectory of a hedge fund manager is you generate a great 3 and 5 year track record, and then you attract a lot of assets. And then if you're running $5 billion, if you want to put a 3% weighting on something, 3% weighting on 5 billions, that's $150 million. So you can't buy a $200 million market cap company. So for me, it's just finding a game where there's less competition, and it's a much less efficient part. It's a much less efficient part of the market. And if you look at kind of historical returns, I mean, there's if you look at the decile of companies in terms of size and their returns, the bottom 10 decile from like 1906 to 1996, I think it was, returned 17.5%. The top decile returned about 9%. So, you're getting 8% alpha by being in the bottom 10 decile potentially, as opposed to the top decile. So, and it's a lot of fun figuring stuff out where there's no sell side coverage and not a lot of people around.
Yeah, absolutely. I think that makes a lot of sense. And maybe speak a little bit about how you initially became interested in investing, and in particular in value investing.
I have to think back now. I grew up in a small town in northern British Columbia, west side of Western Canada. And when you grow up in a small town, you're really good at math and science. You're going to be a doctor. So when I went to university, you mentioned I have a degree in cell biology and genetics. That was my attempt at being a doctor. But about halfway through my undergrad, I realized that really wasn't my passion. And I ended up starting an investment club with a bunch of friends, and started really taking an interest in investing. So that was really what piqued my interest in investing. And then to build out my skill sets, coming from a biology and life sciences background, I wanted to get a business degree to complement my skill sets. So I went to Toronto and did an MBA at Schulich School of Business. And there was a speech the first week of school by a gentleman by the name of Tony Errol, who's the founder of Burgundy. And I mean, he did me such a wonderful service because he talked about this guy by the name of Warren Buffett, who I hadn't heard of. And it was just like, as I'm sure every listener on here is like, the first time you hear about Warren Buffett, you're like, oh my goodness, I have to read everything about this guy. So I went to the library the next day and I picked up the book, The Warren Buffett Way, and I devoured that through my initiation week intro week at business school, and it saved me a whole lot of heartache with some of the more theoretical finance. Just having more of a practical overlay and understanding, the importance of being a business analyst as opposed to a markets analyst. So it was that's really what turned me on to Buffett, and it's been following from afar ever since.
Yeah, absolutely. And let's transition now to speaking a little bit about what is your sort of advice for students who, let's say, maybe one day aspire to start a fund or an asset management company, on knowing when is the right time to, sort of leave being an employee at a company and to really start your own sort of thing, and how to sort of raise that initial capital?
There's a few questions there, and unfortunately, there's no easy answer. And the reality is, if you start your own fund, if you perform over 3 to 5 years and generate a track record, and then you start to tell people about it, you're going to be successful. Because if you there's always people out there looking for alpha, looking for outperformance. So if you can demonstrate that over a 3 to 5 year time frame, you're going to start gathering assets. The knowing when the right time to do it can be a little bit more challenging, because I think the reality is, if you're so inclined to start your own fund, it means you're confident in your own abilities. And the risk is you leave too early before you're actually ready, and then you're not able to generate that track record to generate the returns. So I think the best bet would be that talk to people who you're close to, and see what their reaction is, if they think it's a good idea. And if someone's lukewarm, it means no. It's what you're really looking for, someone to be a big cheerleader and say, absolutely, I think you can do it. And I was fortunate enough, I had one of those friends. And so that kind of helped me kind of get to where I needed to be. And then the other aspect is just your appetite for risk. If you need $3 million a year to support your lifestyle, starting a fund from scratch, probably not a good idea, because it's gonna force you to make some poor decisions on how you build your fund and your firm, because you're going to be making decisions that are in the best interest of gathering assets. Whereas I think this is probably the most important thing I would say about this. If you're starting your own firm, the most important thing is to focus on the investment process above all else for the first 3 to 5 years. Because without that track record, it's going to be a tough slog.
Yeah, absolutely. I think that makes a lot of sense. And our next question is, overall, compared to in the past, do you believe that it is getting easier for companies to maintain their moats as a result of global scale, or harder for companies to maintain their moats because of the rapid pace of technological change?
I think that's a very nuanced question, and it really depends on the industry. So there are some industries that are highly localized, where competitive barriers or competitive advantages are going to remain intact as they have. And this is the classic, focusing on what won't change. People installing HVAC systems is a highly localized business, and that's something that's probably not going to change anytime soon. Car parts, something else which isn't going to change too dramatically outside of a transition from internal combustion to EV. But there are these areas. If we look at technological disruption and global scale, yes, disruption of moats can happen more quickly now. But on the flip side, every threat's an opportunity. So it also means that companies with moats are able to emerge and scale more quickly, which makes it really exciting being investing today, because you can find opportunities now in really early innings which can scale up really quickly and drive pretty fantastic returns in your portfolio. So it's a really good question, because there's two sides to the equation where, yes, the changing technological trends can cause disruption of people's modes of competitive advantage. However, it also gives an opportunity for companies to build theirs more quickly in real time today.
Yeah, absolutely. I think that makes a lot of sense. And maybe give us sort of two case studies of past investments you've made. One that was successful and your thesis played out similar to how you thought it would, and one that your thesis did not play out and ended up being a failure.
Two good questions. I mean, the most interesting one is there's also the example of where your thesis doesn't play out and it's a big winner for you, because there's a positive alpha. But so one company that we invested in was a company called QHR. It was an electronic medical records company. So I think this is a great example of our process, because this was I think it was a $20 million market cap company doing about $5 million of revenue when we first invested in it. And I met with the CEO several times over a couple of years, and I mean, I originally thought the company was going to go bankrupt, but the CEO kept on telling me it wasn't going to go bankrupt and why. And finally, after 2 years of him, continuing to do what he said he was going to do, I was like, okay, this guy knows what he's doing, and I think I can believe that this company is going to be around. So we invested in the business, and we continued to we continued to build our position up, and we became a very big shareholder there. And that actually allowed us, when I talked about the challenges of being a small Canadian public company, one of the challenges is you can be a target for activists. So what that can do is, if you're making long-term decisions, which will, can negatively impact your share price in the short term, a lot of activists will kind of come in those periods of time, build a position, and then say, let's put this thing up for sale because we want to make 20%. And that's a lot of hard work for 20%. We'd way rather let the economics of the business drive that kind of return for a really long period of time. So what we were able to do is become a large shareholder and help provide some insulation to the management team from less patient investors out there. So there were several times where the company did some things, and some things which were right, which created value over the long term. Additionally, they did some things which they probably shouldn't have done, and investors were right to criticize them. But we were able to provide that support to the management team to allow them to really focus on the long term and doing the right thing to build the business over a 3-5 year period. And I think the outcome of that was, we originally bought the stock was around 40 cents, and then the company was sold outright to a large company in Canada for over $3 per share several years later. So I mean, at any point along, I remember the stock was at 80 cents and everybody wanted to sell it, and the stock was at $1.40 and people wanted to sell the company. But because we were able to kind of provide that long-term stable shareholder support for the business, we were able to realize an even better outcome for everybody. On the flip side, the one company where our thesis didn't play out, there was an ESL school aggregator in Canada, and we'd been watching it for a while, and there's a lot of foreign students coming to Canada, and it's a really big growth area. And we saw the quarter where the company turned profitable. So we saw a company with a really high growth rate that was now profitable and looked like execution was on track. And we participated in a financing. So the quarter that was really strong was September 30th quarter, and in Canada for smaller companies, the reporting timelines are looser. So you don't have to report your year-end results until April. So we participated in a private placement in March. and there's a couple of investment banks that had underwritten the private placement, and I made the critical error that we thought the investment banks had actually reviewed the financial statements that were hadn't been released yet, but obviously the management team would have been reporting on them. So that assumption was incorrect. And soon after, the company, when they finally released financial results, it was a complete turnaround from the improvement in the business we had seen in September. So we did the business was not what we thought it was, and we did not do well.
Yeah, I thank you for providing those examples, very valuable insights. And can you speak a little bit about your thoughts of how important a MBA or a CFA is in investment management, and particularly in value investing?
Yeah. Well, I think they're both very valuable. I mean, I've done both an MBA and have my CFA, and I find they actually are very complementary. And so the CFA is it's going to give you the rigorous analytical tool set to value securities and build portfolios. So if you're looking to improve your analytical skills, the CFA is absolutely the way to go. Whereas I think the MBA, and I mean, I know some people will gear their MBA towards the more analytical and quantitative side. But there's a lot more qualitative overlay with marketing, strategy, organizational behavior, all these other courses, which, when you look at value investing today, we started off talking about kind of Buffett versus deep value, and, a CFA is really important for deep value investing. An MBA is really important is more important for Buffett type investing, because that's talking about competitive advantage. It's talking about company cultures, what kind of cultures are going to drive a business to outperformance. So I think both are they're important skills to have, and both are very complementary to value investing. I think there's a little bit of nuance on where one would potentially be more valuable than the other. But I think the more valuable one to an individual is the skill set that you might be lacking or looking to build on. So if you've already got a really strong strategic outlook and background, then a CFA is probably more complementary to your career moving forward. Whereas if you're an accountant and a really strong analyst already, MBA is probably a bit more value.
I think that makes a lot of sense. And maybe speak a little bit about some of the long-term economic impacts that you see as a result of COVID.
Sorry, you cut out for a second there.
Some of the long-term economic impacts that you see as a result of COVID.
So not being a full healthcare expert, I mean, one of how we've looked at it in 2020, we asked ourselves what's changed, and we historically invested a lot in the technology space, and what we saw, the trends accelerating in 2020 as a result of the big shutdown and global pandemic were just increased utilization of software. So like basically work from home was a trend in tech companies. A lot of tech, like there were some tech companies which were completely remote. Bigger tech companies were starting to offer it. Who would have thought 3 years ago that basically every company in the world would have work from home capabilities? And a lot of companies fully support work from home as a choice of employees. And so this trend towards work from home has a lot of really interesting impacts on which companies are going to be successful and which are not. So, and then we're looking a lot at kind of online commerce, and we reflected back on what happened in Asia in 2003 with a big SARS outbreak. And that was the real impetus towards online shopping in Asia. And North America had historically trailed Asia in terms of online shopping. So, 2020 was a kickstart to change the adoption curve of online commerce in North America. Now, I mean, in Canada, it was like 2% of people had bought groceries online prior to the global pandemic, and now 98% of people, I think it is. Please don't fact check those numbers; they're precisely wrong, but they're kind of in the right zone. So there's a lot of these behaviors which were impacted, and then I think when we look at the healthcare space, one big positive, adoption of best practices in technology in healthcare is really challenging because of the multiple stakeholders involved. You've got the payors, you've got the practitioners, you've got the patients, and then you also got like hospitals and care centers in the equation as well. So to create alignment with all these different groups to change patient care, even if it's substantially better, is a whole lot of brain damage. Like that's really hard to do. But when you have a global pandemic, all of a sudden everybody becomes open to change and moving things forward. So I think as a result of this, I think we're probably going to see a lot of operational improvements through adoption of technology and better workflow in the healthcare space. So when you look at how we've actually applied this, we're clearly looking at a lot of healthcare tech companies and technology companies. The other big impact, I think, is we saw the fragility of global supply chains, and I think the reliance on overseas shipping channels, not having manufacturing onshore, I think was a real eye opener for a lot of people, and I think there's probably going to be a bit of a structural change in terms of global supply chains as North America decreases reliance on third parties. So maybe a bit of a reversal of globalization. And I think what we've seen in Ukraine the last month, which is just terrible, it further highlights the need to stabilize supply chains within North America. So I think that's probably another trend we're going to see.
Absolutely. And also maybe speak a little bit about inflation and sort of how you're factoring that into your analysis of companies and sort of how you see that going forward.
Yeah, I mean, inflation's tricky and we're bordering on macro, which is something I just don't like to talk about. And for us, it's really focusing on businesses which do have a moat, which have pricing power. So, you might have some short-term issues with inflation, but as input costs are coming up. But at the end of the day, if you have the ability to pass those price hikes on through pricing power, you're going to be okay. But it absolutely can create some short-term volatility.
And can you talk a little bit about your thesis for Exor? Is it more for sum of the parts sort of valuation, where you're seeing the sum of the parts valuation be a lot higher than what the company is valued today, or maybe expand on that a little bit?
Yeah, it's some of the parts analysis with a wonderful history of capital allocation. I mean, some people call it the Berkshire Hathaway of Europe. So they've compounded capital at really attractive rates for a really long period of time, and you can get that capital at a discount to its value today.
And there's some companies in your portfolio that maybe traditionally wouldn't have been associated with value investing. I think Peloton, for example, and some companies that are currently money losing but are in more of a high growth phase. How do you sort of get past the challenge of these companies currently being sort of unprofitable, and how do you sort of evaluate their intrinsic value?
Everybody loves talking about Peloton. Peloton's a great example. I mean, here's a situation where I don't think I've seen a bigger disconnect between what the customers say about a company and what Wall Street says about a company. I mean, here we have a company with a net promoter score of 88 and 89 on its Bike Plus and tread products. Like that, an NPS of 88 and 89. I think Tesla, is the only consumer brand with a higher net promoter score than Peloton. So that's phenomenal. And when people love products, people tell their friends and people buy more products. And then but that doesn't make it a great company. When you look at the business today, I mean, I think it's easy for people to, talk about a stock. Like the stock was at like $150 and it's down in the 20s today. So there's a lot of people who are very upset. But when you look at the business with a fresh lens today, you've got last quarter they announced, I think, 200,000 connected subscriber ads, and they're up to like 2.77 million connected fitness subscribers, and they pay roughly $40 a month. And the churn is incredibly low. And so that, if you just look at that business as a traditional software company with recurring revenue and low churn, and if you think, well, how much does it actually cost to maintain that cash flow stream? Well, you've got your 10 instructors that you pay $250,000 to $1 million a year all in. You got your tech stack, which you've made a big investment in, and is probably pretty scalable from here. So, can they spin out 40 to 50% margins at steady state? Absolutely. So, when you can get the kind of that cash flow stream at 5 times revenue, and then you're getting the rest of the business, the growth, the hardware, everything else for free. And I know some people can make some comments that, well, maybe it deserves to be free. And we could get in a really long conversation about pricing strategy and inventory management and bringing manufacturing in-house. And I'm not going to say mistakes were not made, because they clearly did make mistakes. But I think we have a situation now where, with a new CEO in, who's been in similar situations. So, and I think this ties into your question about how does a value investor invest in money-losing companies? And I think modern accounting doesn't do an excellent job of capturing the economic value of people-based businesses. I mean, accounting standards were built sometimes, it feels like in the 1800s sometimes, because some of it's just so ridiculous. But the accounting standards were built for, somebody building a sawmill and, being able to use that sawmill for 20 years. So you make a big upfront investment, and, then it generates cash flow for 20 years, and you amortize it over that period of time. So accounting was set up for making these big upfront investments and then amortizing it slowly over an extended period of time. In a software company, your investment is the people coming to work. And it's the engineers who are building new product. It's the salespeople who are going into new geographies. And so, I mean, our team spends a lot of time doing, and I can do this all day long because I love trying to figure it out. It's when we're looking at these software companies or these technology businesses, it's really trying to figure out how much of your R&D and sales and marketing is necessary to maintain the business, and how much are you actually putting into growing the business. And when we can get good insight into what we think that may be, because I mentioned, we're looking for return on invested capital in these businesses. If you're losing money, what's your return? Well, it's negative. So what's your return on capital or invested capital? Well, it's terrible. Like it's uninvestable. But if you can have a thesis on what you think the actual underlying free cash flow generating ability of the business is on a maintenance basis, and then you understand what your real investment is, you can actually back into your return on invested capital calculation, and whether or not it's a wonderful business that can deploy capital at high rates for a long time, or if it's something you should avoid. So does that answer your question? I get excited about that one, so that's a good question.
Yeah, absolutely. Thank you. That was a really great response. And I think you have some SPACs that you're invested in that are pre-merger SPACs. So maybe talk a little bit about that.
Yeah. So I think we're pretty much out of SPACs now. and I'm investing the probabilistic endeavor. And when we look at investment, we chart what's the bull case, what's the base case, and what's the bear case. So SPACs are really interesting because you know what the bear case is. If you don't like the deal, you get your money back. And I mean, there's all these arbitrage funds which are using SPACs as basically a cash proxy, because it's you can get a very defined rate of return, and we have a fund set that one of my partners runs that takes advantage of this. So but then when you look at the base and the bull case, I mean, we had a period of time in early 2021 where your bull case was the company announces a credible SPAC sponsor announces a really interesting transaction, and you're going to $20. So when you're buying these SPACs at $10 and you can basically get out at cost and you're getting warrants attached, there's so much asymmetric return profile there that you can do really well by having these SPACs where a deal gets announced and it goes up. Now, that was early 2021. We're now in early 2022, and the probabilities have changed totally. We very rarely see a deal get announced where a SPAC trades up as a result. And so what we've seen is a proliferation of ARB funds, being the shareholders of SPACs. So they're not betting the share prices going up. And in fact, if it starts going up, they're probably selling. So the dynamics in that market has changed quite dramatically, but it was really interesting because for a brief period of time, the probability of the bull case went up quite dramatically, which made it a very attractive asset class with very little downside.
And so for our concluding questions, what are the most influential events of your investing career?
The most influential events of my investing career. So early in my career, I went into venture capital because I loved technology and I loved investing. So it was a great way for me to join my two main interests. But I also had this, when I started in May of 2000, which was right near the peak of the dot-com bubble, and I was also a Warren Buffett fan, and so I was trying to be a private technology investor with a value lens, and it was really hard to do because there was no such thing as value investing back then. And I was trying to figure out how it was all working. And then obviously, the market landscape changed quite dramatically. And I started looking actually at a lot of public companies, because in Canada, a lot of these public companies went public, or tech companies went public in 98, 99. And then in 2002, 2003, and on, these companies were all just stranded there. And so I started looking at all those companies. And that was, I remember I read Phil Fisher's book, Common Stocks, Uncommon Profits. And I'm just reading about his approach to investing. And it was so interesting because he was a venture capitalist doing deep due diligence, looking at public companies, and really being a value investor while doing so. So that was really the book that kind of pulled it all together to me. And I was like, this is what I want to be doing. And so that really drove my passion for investing in small cap stocks in Canada, and really paved the way for us to launch our traditional funds in 2009.
Yeah, excellent. Thank you so much. And thank you so much for the session. It's been really excellent. And we appreciate you taking the time out of your busy schedule to speak with us today.
Thank you. Thank you for your time.
Thanks. Have a great day.
You too.